Welcome to Ekcel Academy's YouTube channel. Today we'll be looking at company accounts or rather corporate accounting. So in that we'll be looking at Consolidation of Accounts as per Companies Act 2013, which is lesson number 7 in the study material. So let us look at the learning objectives. This is one of the most important chapters, even from the point of view of understanding as well as from the point of view of marks. You will get a few questions. From this it's easy to ask few questions as MCQs. Let's see what exactly we are supposed to understand first. To understand the concept of holding company and the subsidiary company, the legal requirements relating to the presentation of accounts by a holding company and Schedule 3 requirements obviously, then preparation of consolidated balance sheet of a holding company and its subsidiaries, and various steps involved in preparation of all this. So that is the broad outline which we are supposed to understand. Then comes the part where we have few definitions. Let's start with this first definition, which is holding company. So according to section 246 of the Companies Act, holding company in relation to one or more other companies means a company of which companies are subsidiary companies. um, we know why we say law is an as, because the way this is drafted is so horrible that in one reading one may not understand what exactly is a holding company. So basically holding company is one which holds other companies, and those other companies are referred to as subsidiary companies, as simple as that. So now I use the word subsidiary companies as well. Now what is the meaning of that? Again, let's see what exactly has been defined here. Subsidiary company or subsidiary in relation to any other company means a company which the holding company controls. What do they control? They control the composition of the board of the directors, or exercises or controls more than one half of the total share capital. So basically, under two circumstances, we say a company becomes a holding company. Which are those two circumstances? One, where the composition of the board of directors is controlled. The other, where more than one half of the total share capital is controlled by the other company. So in these two circumstances, we say a company becomes a holding company. Provided that such class or class of holding companies as may be prescribed shall not have layers of subsidiaries beyond such numbers as may be prescribed. Not required. Completely ignore all those things. Okay. See, one thing which you have to do when you are preparing for exam is your goal should be very clear. You are preparing for an exam and your aim should be to pass. Our aim here is not to understand thoroughly what is this holding company, what is the process of consolidation of accounts, all those things. From the point of view of exam, whatever we require, whatever is necessary for us to pass the exam, we will learn that. That's all. The rest can always be studied later. So that's why what I do is, whenever, if I was a student, I would still be doing that. I would recommend you to do that same thing. What is that? Strike off whatever you think is too much, or whatever you think is beyond the scope of the exam. Because if you are a student appearing for CS exams, I would guess that you would have already seen the question paper. Not just one paper, many papers, because this scheme has been there since many years now. Based on that, you can easily guess, just by looking at the last 7-8 attempts question papers, you will get an idea as to what kind of questions will actually appear from respective chapters and subjects as well. So when that is the case, try to eliminate things from the material. Keep a pencil, strike off things which you think are too much. So that way, when you are doing the revision, you don't have to worry about reading some unwanted stuff once again. As it is, the material is so badly drafted, you do not want to go through the same thing again and again when revising as well. Going through this material once itself is going through hell. Anyway, let's move on. What else? One more thing which you can do with respect to these type of theory questions or theory concepts is simply look at the past exam questions. You of course get scanners and various textbooks wherein they will prepare the MCQs and give you readily, so that way you can just directly look at the MCQs and try to understand. Otherwise, when you are reading this, you'll have to then mark something as important, or maybe that is important and then it might come for the exam. All those things you'll have to do. If you have time, I would suggest you to do it on your own. If you are preparing only for one module, I can say you should do this because you can easily prepare the notes. But if you are preparing for both the modules, then I would suggest try to cut down on the time required for preparation. Anyway, now what else do we have? Shareholding of a holding company by subsidiary. Holding company can and does hold shares of the subsidiary, correct? But a subsidiary company can't hold the shares in its holding company. That's okay, that we have understood. Share allotment made to subsidiary is void. Okay, so that means if A Limited holds B Limited, B Limited cannot hold any shares of A Limited because they say it becomes null and void. So we have to be careful about that. The restriction applies even if shares are held by nominee of the subsidiary company, not by the subsidiary company itself. That is also there. If the nominee, if there is some nominee, and if that person holds the shares of the holding company, even then it is void. That is what they say. There are few definitions given here. Please go through that once. The most important definition for us here is minority shareholder. Who are these minority shareholders? A shareholder who is holding shares of nominal value of rupees 20,000 or such other sum as may be prescribed is known as small shareholder. Okay. Then what about the minority? Equity holder of a firm who does not have the voting control of the firm by virtue of his or her below 50% ownership of the firm's equity capital. So this can also be easily explained. Let's say a firm has 1,000 shares, firm in the sense company has 1,000 shares, and out of these 1,000 shares, 600 shares are owned by A Limited and remaining shares are held by others who are referred to as minority shareholders because they do not have majority control of the company's equity capital. If you look at it, they have only 400 shares out of 1,000 shares, meaning their ownership is obviously below 50%. So therefore they are referred to as minority shareholders. Again, they have given few legal requirements of a holding company. We will not get into that. So for us, what is important here is the steps which we need to solve a problem based on consolidated financial statement. Meaning, if at all they ask you how to prepare the consolidated financial statement, what is this consolidated? We are just merging the balance sheets. If at all they ask you to prepare balance sheets of two different companies, that is holding and subsidiary, we will merge them and then prepare the consolidated financial statement. Obviously, for your scheme of examination, we won't get these type of questions, but what we will get is steps involved in CFS. For example, they may ask you to prepare amount to the extent of minority shareholders. Maybe they will ask you to calculate capital reserve or maybe even goodwill. So these kind of questions can be asked as part of MCQ questioning. So this is the format of consolidated balance sheet. They are given the format, not important. Again, just read it once. Anyway, you are not going to prepare the balance sheet, so why simply bother? So here what is of interest is the minority interest. So this is an item which is normally not there in any balance sheet. Only when we are preparing the consolidated balance sheet, immediately after the equities and liability side, we show the minority interest. So then look at this. This is also very interesting. Intercompany or mutual owings is removed here. For example, current liabilities, let's say 500 crores of creditors is there, and in subsidiary company we have 200 crores. If one company owes to another company, that is if the holding company owes to subsidiary or vice versa, we remove that intercompany owings here and then show the net outside, because we can't owe to ourselves, because in this case consolidated financial statement means what? We are clubbing both the financials, right? So when that is the case, we can't be owing to ourselves. Only when we are preparing CFS, both holding subsidiary become one. So they are not separate entities during the preparation of CFS. Only here. Everywhere else, they have their own separate legal entity. Okay. So they have directly gone to the problem. Let's also do that. Okay. So we have the consolidation of accounts. So now let's we saw all this, no. Meaning of certain terms, ownership, okay, more than one half, that also we saw, either the control of board of directors or the shareholding pattern where more than 50% is controlled, so that is consolidated. Minority interest also we saw. Okay. Okay, now this is very important. So there are various steps involved in solving the problem with respect to consolidated financial statements. Let us look at each of these steps. First step, date of acquisition, because without this date of acquisition nothing else can be decided. Now what is this date of acquisition? This is the date of acquisition wherein the holding company has acquired a controlling interest in the subsidiary company. So when did they invest in this company? So this date of investment is required from the point of view of ascertaining the capital profits or the revenue profits, which we will see in a minute. But for now, understand that this date of acquisition is what decides what is capital profits or pre-acquisition profits, or what is revenue profits or post-acquisition profits. So now let us look at one simple example here. X Limited acquired Y Limited. Okay, acquired means they would have acquired shares in Y Limited, majority shares basically, on 1st September 2016. So this is the date which is relevant for us. This is the date of acquisition. So now whatever the company has earned, that is whatever the company Y Limited has earned before this date, before the shares of Y Limited or the majority shares of Y Limited were acquired by X Limited, would be considered as capital profits. It would not be the profits which the company earns after the acquisition, but it would be the profits which the company has earned before the acquisition. So that's why it is also known as pre-acquisition profits. That is one thing. So in this case, pre-acquisition period time frame would be from the start of the year, that is the financial year we know starts from 1st of April till the date of acquisition, which is 31st of August. So how many months are there when it comes to pre-acquisition period here? 5 months. So from this date onwards, from the 1st September 2016 onwards, this will be the post-acquisition period. In this case, it is of 7 months until the end of the financial year, which is 31st of March. So that is the thing. So that is the step 1, most important step. Then comes the step 2, which is shareholding pattern. So this shareholding pattern is nothing but how much has the company invested in the holding company. So in the subsidiary company. For example, let's see what exactly they are going to say first. Determine the shareholding pattern of the subsidiary company as on the date on which consolidated financial statement, actually this is financial statement or balance sheet, is to be prepared. The pattern is essential for apportioning of subsidiary profits, they say. This again we'll have to consider when we do the problem, but for now let us understand what exactly they are referring to when it comes to shareholding pattern. Okay, now if you look at this, let's read the example. X Limited acquired Y Limited, okay, on 1st September, the same example we are continuing here, that's fine. The share capital of Y Limited, now they are talking about the share capital part, was 1000 shares of rupees 100 each. So 1000 shares of rupees 100 each, so that would be 1 lakh is the share capital. So X Limited, that is the holding company, they acquired how many shares? 800 shares. So out of this 1 lakh of share capital, 800 shares into 100, that is 80,000, was acquired by the holding company X Limited. So what about the remaining 200 shares which it did not acquire? So that would be nothing but the minority interest, the shares held by others who do not have the majority shares. So now we can easily calculate the percentage as well, number of shares held by the holding company and number of shares in the subsidiary company. So we know in this case the total number of shares in the subsidiary company is 1000. Out of that, 800 is held by the holding company. So simple math will tell us the percentage of holding. So this would be nothing but 80%. So if 80% is held by them, what about the remaining 20%? This is held by others, who are also referred to as minority interest or minority shareholders. So we are done with two steps. Step number one, once again, was what? Date of acquisition. Step two was what? Step two was identifying the holding pattern or the shareholding pattern or the control ratio. And now we are in step three. This is one of the most important steps, or I can easily say this is the most important step in the entire process of preparation of consolidation of financial statements. Now let's see what does this step say. Analysis of subsidiary revenue. So we have to identify the profits and other reserves in the subsidiary company. Okay, let's see. The reserves to be analyzed shall be reserves as appearing in the balance sheet of the subsidiary company. Once again, balance sheet of which one? Subsidiary. Reserves could be my P&L balance, general reserve, or anything else, maybe securities premium, etc., etc., various reserves. So how do we analyze that? That is one thing. As on the date of preparation of CFS, that is Consolidated Financial Statement, subject to adjustments relating to proposed dividend, bonus, unaccounted items. So now in the exam, this is something which is often asked. So what they will do is they will tell that the subsidiary company had so much in P&L balance, let's say 10 lakh rupees on 1st of April 2021. Out of this 10 lakh rupees, the company issued dividend of 50,000. So how much would be the revised balance of P&L? So based on that, you will have to split. So between the holding company and subsidiary company, between pre-acquisition and post-acquisition, all those things will come into picture. But for now, understand, this has to be analyzed. This has to be taken into consideration. When I say analyze, you'll have to look into it. How to, we'll see later. In certain cases where assets are revalued means the value of the assets may go up or come down. The surplus or the deficit should also be considered. Once again, we'll have to take into consideration, and that will affect my existing profits, reserves, etc. Profits should be appropriated where practicable on a reasonable basis. They say, for instance, basis of time with the assumption that profit have accrued evenly during the year. This is one of the most important assumption, though faulty, which we make when it comes to consolidation. See, now if we say a company has earned 10 lakhs of profit, we assume that this 10 lakhs has been evenly spread across the whole 12-year period. 12-month period, that is from April to March. But in reality, it may not be the case. Obviously, it won't be the case. But for the purpose of consolidation, what we do is we will assume that this 10 lakhs was spread across this period of 12 months. So that is one assumption which we have to make if we have to prepare the CFS. And lastly, the balance sheet date may be considered for determining pre-acquisition profits. This is usually the same, so we don't have to worry about that. Anyway, we'll look into one simple problem and see what exactly we are supposed to do. We are continuing the same example. X Limited acquired Y Limited on 1st September 2016. Fine. Date is given, acquisition date. The share capital of Y Limited was 1000 shares of rupees 100 each, fully paid. X Limited acquired 800 shares, which is 80%, we know that already, on 1st September 2016. That is also fine. Now they are giving additional details. Which are those additional details? For example, they are telling us how much is there in reserves and surplus. So 50,000. On which date? On the date of closing balance sheet. So when are we closing the books of accounts? So this is the financial year 16 and 17, which starts on 1st April 2016 and ends on 31st March 2017. So now they have mentioned, as on the date of closing of books, that is the balance sheet date, we have reserves of 50,000, and they've also mentioned how much reserves were there on the opening date, that is 1st April 2016. This is the day when the year started, that is 1st of April 2016. So that is the opening date and the closing date. So both the opening balance of GR as well as closing balance of GR is mentioned. Finally, they also have given us the data with respect to proposed dividend. They say proposed dividend of 10,000 is not accounted for. Now we have to analyze the reserves, like how much of these reserves um, were there in the opening of the at the time of opening of books and at the time of closing of books. We will incorporate that into a ledger account here. So now reserves and surplus account is opened. In fact, there's a printing mistake here. Okay, ignore the printing mistake. So now let us look at the balance brought down. So since this is a liability, so liabilities we know will always have credit balance, so we'll have to bring it down on the credit side. So what was the opening balance? Here we have 20,000, so that will be by balance brought down. Since it's a liability, it will always have a credit balance, so that we have brought down. Closing balance is also mentioned, that also we will incorporate. Since the liability account will always have a credit balance, so credit side will be greater, though even though we do not know by how much. So I mean, how much is the total of credit side, we do not know, but it is greater by 50,000. That is what we know. We are incorporating the given. One more given is proposed dividend, which is 10,000, which has not been accounted for. So let us account it. So proposed dividend, the entry would be very simple: reserves and surplus to proposed dividend. So why should we pass this entry? Reserves and surplus is a liability which is decreasing, and proposed dividend is a liability which is increasing. From one liability we will transfer into another liability, because we are saying that we had so much of reserves and we are proposing to give dividend to the shareholders to the extent of 10,000. So until you make the payment, proposed dividend will be liability. Once you make the payment, it will be proposed dividend to bank. So that is how you close that entry. But anyway, that is not of our concern. But for now, we have understood that we have accounted for proposed dividend as well. Opening balance done, closing balance done, proposed dividend done. So now what is the difference here? This difference is 40,000. You would just total this 60,000 on either side, and the difference would be 40,000. Now this difference is nothing but the transfer made from the current year profit and loss. So what happens if you imagine the horizontal P&L account at the end of the day? So we appropriate the profits and transfer to GR. How much was transferred to GR? 40,000 was transferred to general reserve out of the current year's profits. So that 40,000 is what we have here. I hope it is clear. So now this is with respect to reserves and surplus account. Have they mentioned anything else in the problem? Nothing else has been mentioned. So we only looked at the reserves and surplus. Sometimes what happens, they will also give the data similarly with respect to profit and loss account as well. Meaning they will give the opening balance of P&L, closing balance of P&L, and maybe we'll have to calculate stuff like how much profits did the company actually earn during that year. So that also we will see in a second. But for now, let us move on to the next step, which is the analysis of profits or apportionment of profits. In fact, I would say this is far more important than the previous one. Anyway, let's see. So now we will have to look into the pre-incorporation, or rather let's say capital profits and revenue profits. So this is what we will be looking into now. So how much is the profit which the company had even before the date of acquisition, and how much profits did it earn after the date of acquisition? Which company? Subsidiary company. We are looking at subsidiary companies' profits now. Okay, so let's see. Pre-acquisition profits. Here we have divided this into three divisions: holding company, which holds 80%, and minority interest, which is nothing but remaining 20%. So based on that, we will split the profits, and finally we have total of 100%. That is anyway obvious. So now let us look at the pre-acquisition profits or the capital profits. What do we have? We start with the opening reserves and surplus. This is something which the company already had even before it was acquired by the holding company. So now how much was the opening profits? So it is already mentioned 20,000. So on April 1st 2016 it was 20,000. So first we write this 20,000 in the total column. Then what we will do, we will split between holding company and the minority interest in the ratio of control ratio. So that also we had already calculated. So if you split 20,000 into 80% and 20%, you will get 16,000 and 4,000. 20 into 80, 16, 20 into 20, 4,000. Then to that what should we add? Add any profit which was earned by the company before acquisition, before the day of acquisition. So now we know one thing here. From P&L, how much was transferred to GR? 40,000. Since P&L account balance or rather P&L account details is not mentioned, we will consider that entire 40,000 is current year profits. Current year profits is 40,000. And now what we will do is we will split that 40,000 first of all. Let's say if this is my 40,000 profits, this we will assume was earned from April to March. And we know for a fact that the company was acquired on 1st of September. So how many months here? 5 months. So remaining profits would be for 7 months, which is post-acquisition or revenue profits. Once again, pre-acquisition period is called as capital, or rather the pre-acquisition profits is also known as capital profits. Post-acquisition profits is known as revenue profits. So now do the math. 40,000 into 5 by 12. That would be 16,666. So out of this 16,666, 80% will go to X. So 16,666, 16,666 into 80% will be 13,333. And 16,666 into 20% will be 3,333. So that is what we have done. Once again, first split the profits between post and pre-acquisition. Pre-acquisition was 1666. Then further split that between minority and holding company, which came to 33,333 and 3,333. So that is something which we have done. So we do not have anything else here. So we can directly proceed towards what the revenue profits. Is there anything else? I'm just looking. Yeah, actually there is one more thing. Okay, anyway, nothing. So they have not mentioned the date here with respect to dividend, so no need to make assumption. Anyway, that's all. No, yeah. So now 1666 was pre-acquisition. The remaining out of 40, that is 23,334, would be, sorry, 16,666 was pre-acquisition, and remaining 23,334 is the post-acquisition or the revenue profits. So once again, do the split, 80% and 20%, which comes to 18,667 majority or the holding company, and minority shareholders will get 4,667. That's all. So now what you are supposed to do is total the capital profits, which comes to 29,333 for X Limited, and minority shareholders will get the remaining 733. Likewise, total the revenue profits also. Here I am saying total, but in case of pre-acquisition at least we have 2 items, whereas in case of post-acquisition we have only 1 item. That itself will be the total. If it's an elaborate sum, we will have various items. Usually the pre-acquisition part will have more items, and the post-acquisition will have only 1 or 2 items at best. So now what we just now did was we analyzed the profits and apportioned the profits between pre and post acquisition time periods. Now half of the work is done. In fact, majority of the work is actually done because this is where most of the time will be spent, this working note, step 4. Now one of the most easiest working notes, which is computation of minority interest. So how much is minority interest, or how do we calculate this? Okay. We already know what is minority interest. Let us directly get into the problem. Okay, let's see. Taking the same example, we are just continuing the same things so that we will understand it easily. Now let us try to understand how to calculate this. First thing, when it comes to minority interest, first look at the share capital itself. So we know that the minority shareholders hold how much? 20%. Okay, this is not 25, 20%. So 1 lakh is the share capital, 80% is held by holding company, or the majority shareholders. Remaining 20% is with the minority. So 1 lakh into 20% will be 20,000 itself. Then comes the pre-acquisition profits and post-acquisition profits share. What is the minority interest share of pre and post acquisition? We can go back here. We can check the pre-acquisition profit share is 7,333. Post-acquisition is 4,667. Just write that as it is. Pre-acquisition 733. Post-acquisition 4,667. So now the total of this would be the minority interest. As simple as that. Nothing else. So what are the things which we have to consider? Share capital, their percentage, basically whatever is that. It could be 20%, 30%, 40%, whatever, as long as it is less than 50%. Then their share in the pre-acquisition profits are also known as capital profits, and their share in the post-acquisition also known as revenue profits. When you total all this, you will get a consolidated figure which is referred to as minority interest. Then comes the step 6, which is determination of cost of control. So now what is this cost of control? This is again a very simple thing. So let's say a company has paid 10 lakh rupees for acquiring some shares in another company. Now the question arises, by paying 10 lakh rupees for the shares in another company, what is it getting in return? If it is getting more than what it has invested, in this case it has invested 10 lakhs, if it is getting returns worth rupees, let's say 15 lakhs, it is a capital profit. Basically we are benefiting here from this investment. So that capital profit is known as capital, or rather it will be transferred to a separate account called capital reserve, because all capital profits should be transferred to capital reserve ultimately. This is when we are getting more in return by investing 10 lakhs. We can also think of another situation wherein our returns are actually less than 10 lakhs. Let's say I'm getting only 8 lakhs worth of benefit by investing 10 lakh rupees. So in that case, I'm actually incurring a loss of 2 lakhs. We don't call it as loss, but instead we consider this as the goodwill which we pay for acquiring the majority stake in that business. We have acquired majority stake obviously, but by paying some extra amount. Even though the company is worth rupees 8 lakhs, we paid 10 lakhs because we thought in future this company will benefit us, like what Meta did with WhatsApp or even Insta. In both these cases the company paid far more than their worth, so that is nothing but goodwill. Okay, so because they realized that it will benefit them in future, and it did obviously. So that is what we do in case of determination of cost of control. So for example, let's read this. X paid 1 lakh to acquire 8,000 shares. Now here we have to be careful. So let's see what all we have to consider. So now cost of the investment is already given. We have paid 1 lakh to acquire 8,000. I will consider that as it is. Now then we'll have to deduct the benefits or whatever we are getting in return. First benefit would obviously be the face value, that is the share capital, our share in share capital. So we have 800 shares of rupees 100, so that will come to 80,000. Then comes the pre-acquisition profits. So even before we acquired, that company had earned profits, it had some amount in the reserves. Simply by having the majority shares in that company, we will definitely have a hold over that too. Whatever the company had earned earlier, now because we are majority shareholders or we are also shareholders of the company, we will also have some right, in fact majority rights over whatever the company had earned even before we had invested in that company. So that is what is called as pre-acquisition profits, also known as capital profits. So we have already calculated all this, so we'll just go back to that and check the amount. 29,333 is the total pre-acquired profits or capital profits. This is also a benefit. We are getting this benefit, no? So now we will deduct that too from the investment. So when you do that, we are getting a negative figure of 9,333. That means what? We are actually benefiting from this investment. What is the total benefit? 9,333. So that 9,333 is referred to as capital reserve. Then lastly, not lastly, but before the last step of consolidation statement, we have one more thing which we need to take care of, which is intercompany transactions. If there are any intercompany transactions, we'll have to just remove that, because as I said earlier, we cannot make profit by selling to ourselves. So let's see. Y had sold certain goods to X Limited at rupees 20,000. Okay. The subsidiary had sold to holding company whose cost was only 18,000. So they have made profit of 2,000. But if this H Limited, the holding company, if they had already used it, then it wouldn't have been a problem. But out of the goods sold by Y Limited, goods worth rupees 2,000 was still lying with X. They had not used everything out of the 20,000. 2,000 was still lying with them. That means we have to identify what is the element of profit in this 2,000 rupees. Because when Y sold this to X Limited, that is the holding company, they sold it at a profit. Its cost was 18, they sold at 20,000. Now, if that is the case, how much profit is lying unsold in 2,000 rupees? That is what we have to calculate. So, which is also known as stock reserve. Let's look into that. Calculation of profit percentage for stock reserve. Let's see. What was the cost? 18,000. Profit on that cost 2,000. So selling price 20,000. So now how to calculate the profit percentage? Very simple. Whatever profit we made divided by the selling price into 100. So 2,000 was the profit. Selling price is 20,000 into 100 will give us 10%. So we know, as on the date of balance sheet, that is closing day of the year, we had closing stock of 20,000. So now in this 20,000, we had some 2,000 worth of stock which was actually sold by Y Limited to X Limited. In the 2,000, we'll have to eliminate 10%, which is nothing but unrealized stock, or also known as stock reserve. So 2,000 into 10%, which will be 200. So 200 is a profit which is still not unaccounted, unrealized in 2000, because Y Limited had sold at 10% profit. So remove the 200 and show 19,800. This will be the actual cost. There is no profit here. So this is what we are supposed to do if there are intercompany transactions. Ultimately, then we prepare the balance sheet as the last step. Now, let us look at the problems. On 31st March 2017, the balance sheet of H Limited and its subsidiary S Limited are as follows. Share capital is given of rupees 10 each, 4 lakhs of holding company. So unless otherwise mentioned, H is the holding, S is the subsidiary. I mean, of course, they will mention here for convenience sake. We have grouped them like that, or rather named them like that. So then S Limited is 1 lakh. General reserve, this is obviously the closing balance because it's the last day of the balance sheet. So last day of the year on which we have prepared the balance sheet here. So then 7535, we have profit and loss account as well. In the previous examples we did not have profit and loss account. Interesting, maybe in this case we will also know the opening balance, we will see. Then we have other current liabilities, which includes creditors and bills payable. So that's the liability side of the balance sheet. Then we have the asset side, wherein we start with the non-current assets of land and building, machinery, and investment in S Limited. So this is important. So now only H Limited can have this, because only H Limited has invested in the shares of S Limited. So how much have they invested? They have invested to the tune of 7,500 shares by paying how much? 1,40,000. So that is something which we get to know only by looking at the balance sheet. Then there is some preliminary expense, an intangible asset, and also a fictitious asset. This is really not an asset. We have to write this off as and when possible. We'll write it off very soon. So we have 5,000 in case of holding company, which is not relevant for us. This is relevant, which is 2,000, because we'll have to write this off using the balances in reserves. Then we have various assets, not important. Draw a consolidated balance sheet as at 31st March 2017 after considering the following information. So there are few additional information available. H Limited acquired the shares on 31st July 2016. So they acquired 7,500 at 1 lakh 40, I believe. Yeah, that is the one. No? Yeah, 1 lakh 40,000 on July 31st. So that is the first step wherein we find out the day of acquisition. We have found out that 31st July. We will have to consider the pre-acquisition period and the post-acquisition period there. The balances of general reserve and profit and loss account on 1st April 2016, that is the opening balance, was how much? 10,000 rupees. So that is with respect to general reserve opening balance is 10,000, whereas in case of profit and loss the balance is 7,500. So this is required. That means we'll have to prepare the general reserve account as well as the P&L account for subsidiary company. And in January 2017, H Limited sold to S Limited, that is holding company sold to subsidiary company, goods worth rupees 7,500 for rupees 10,000. That means there is a profit of 2,500. So if this 10,000 is completely utilized by the subsidiary company, then there is no issue. But they go further and say 50% of these goods were lying as unsold in the godowns of S Limited. To that extent, we'll have to remove the unrealized profit, so which is nothing but stock reserve. We know how to do that. Then there is bills receivable, where they say bills receivable of 12,500 of H Limited are received from S Limited, meaning whatever bills receivable they have here, out of this 12,500 we have to get it from S Limited. So now S Limited has bills payable of 15,000. If they have bills payable of 15,000, out of that bills payable of 15,000, 12,500 relates to bills which needs to be paid to the holding company. So we'll have to remove that intercompany owings. Then finally they say, oh no, there are two more adjustments after this. Okay, creditors of S Limited include 6,000 due to H Limited. One more intercompany owings. So whatever creditors S Limited has, that let's say, where is that? 25,000. Out of that 6,000 relates to the holding company. Likewise, in 80,000 debtors of holding company, 6,000 relates to something which we are supposed to receive from subsidiary company. So we will remove those intercompany owings, because once we are merging the balance sheets of both the company, we can't owe ourselves, we won't be liable to pay ourselves. Then S Limited remitted a check for rupees 1,500 to H Limited on 30th March 2017, which was received by H Limited on 1st April 2017. That means we have already removed from S Limited. Check has been issued, but H Limited only received that on 1st April. Basically, it is cash or check in transit. Okay, we'll have a look into that when we prepare the balance sheet. Until then, we don't have to worry about all this. All this means 1, 2, 3. These three adjustments will look into account only at the end when we are preparing the consolidated balance sheet. Until then, we don't have to worry about it. So now, what else? No part of the preliminary expense was written off, they say. That is interesting. But we will ignore this and write off. Why simply retain the preliminary expenses when we already have enough amount of profits? We'll write it off. So let's look at various steps one by one. First step is date of acquisition. We have already seen that. Where is that? 1st July. Sorry, 31st July. No, yeah. So that means 1st April to 31st July would be which period? This would be the pre-acquisition period. And 1st August to 31st March would be the post-acquisition period. So how many months? April, May, June, July. So that means 5 months and 7 months. Oh, sorry, I made a mistake here. Not 5, no, it's 4, right? April, May, June, July. April, May, June, July. So that means 4 here and 8 here. Okay. That is one thing. Then comes the control ratio. So control ratio, we have already seen how to calculate. Number of shares held by the holding company. Held by holding company in what? In the subsidiary company. So that is given in the balance sheet. It is not mentioned anywhere else. Here they have very clearly mentioned 7,500 shares at cost held by H Limited in S Limited. How many shares are there in case of S Limited? Share capital is 1 lakh. If you divide 1 lakh share capital by face value of share, which is 10, you will get 10,000 shares. Out of these 10,000 shares, 7,500 shares are held by, which is that holding company H Limited. So now it's easy to calculate the, what is that control ratio. Oh my goodness, it's not zooming out. Yeah. So now 7,500 is the number of shares held by holding company and number of shares in the subsidiary company. As a percentage, we don't even have to calculate it, 75%. Okay, that is done. Then what else? So general reserve, this is nothing but the analysis of profits and reserves. Okay, so now let us go back to the adjustments or the additional information. Let me just erase everything so that it's easy for us to read. So now what do we have here? Opening balance of general reserve, they say 10,000. So 10,000 is brought down. By balance brought down, liability. So bring it down on the liability side. That is okay. Likewise, if you look at the balance sheet, you will get the closing balance as well. So which is 35,000 closing balance. So this is the balance which we are worried about, 35,000. So opening balance and closing balance, if there is a difference, that means some amount has been transferred from P&L. So we have incorporated the closing balance as well here. This is given. This is also given. So what is not given is the difference here. This difference is nothing but the amount which was transferred from P&L account. So what is this? This is the profit which the company would have transferred from P&L account to GR. So that is the difference which we calculated. So now let us open the profit and loss account as well. Why? In the previous instance we did not open this because we did not have information regarding that, but now we have the information. So because there somewhere mentioned, no, yeah, opening balance of P&L is 7,500. So bring it down, opening balance 7,500. From the balance sheet we know the closing balance is 27,500. Let's just confirm once. 27,500 is the closing balance of P&L. So if you see, you will know. Then we also just now transferred, or rather identified that some amount from P&L was transferred to GR. In GR we have written by P&L, so the entry would be P&L account debit to GR. So in the P&L account we'll write on the debit side to GR 25,000. We have transferred so much from current year profits to GR. So this was given, so we just incorporated. This is also given. This is ascertained in the previous working note itself. So what is ascertained in this working note is the balancing figure, which is nothing but the current year profit. So this is how you identify or ascertain the current year profits, by preparing the P&L account of the subsidiary company using opening and closing balances data, and also if at all there is anything like this current year transfer to GR, we do that too. Now let us move to the analysis of profits. This again is, as I said, the most important, more important than this. This is also important, but this would be the most important step. Now we know we have to divide this into capital profits and revenue profits. Let us look at one by one. As I said, we have sufficient reserves and P&L balance, so we will write off the preliminary expenses. So how much was the preliminary expenses of the subsidiary company? It was 2,000. So you can go back and check in the balance sheet. So 2,000 is the preliminary expenses with respect to subsidiary company, that we will write off using the opening reserves. So but 2,000 we will write in the total column, but we know the control ratio is 75% and 25% between holding company and minority interest. So we'll have to split the 2000 accordingly. When you do the math, 2000 into 75%, you will get 1500. 2000 into 25%, you will get 500 rupees. So that has to be in negative. Why negative? Because we are writing off, meaning we are removing so much from the profits. So therefore it has to be in negative. So once that has been taken into consideration, let's move to the opening general reserve like we did in the previous problem. The only addition here is the opening P&L as well. This we already know, 10,000, that has been split between holding and minority in the ratio of 75-25. Same thing with the opening P&L, 7,500 split in the ratio of 75-25, which will be 5,625 and 1,875. You can do the math and confirm once. So that is also taken care of. Now comes the profit during the year, which we just now ascertained to be 45,000. But as we have already seen, we will assume that this profit of 45,000 is assumed to have been earned across the year, that is from April to March, uniformly. So that means we'll have to now consider based on the time frame. So we have already seen 4 months will be pre-acquisition period and 8 months will be post-acquisition period. So therefore 45,000 into 4 by 12 will be the pre-acquisition or the capital profits, which is 15,000. First we'll split that. Likewise 45,000 into 8 by 12 will be the remaining 30,000, which will be revenue profits or the post-acquisition profits. Now let us do the further split. That is 15,000 into 75% will be 11,250. 15,000 into 25% will be 3,750. Likewise, we'll do the same thing in revenue profits or post-acquisition profits. 30,000 into 25% will be 7,500. 30,000 into 75% will be 22,500. So now we'll just total this and we'll get 22,875 as capital profits or pre-acquisition profits. And revenue profits, there is nothing much to do here, only one item. So 22,500 and 7,500. So now we have done the bulk of the legwork. So what is left is a few more things like minority interest, etc., etc., cost of control. Let's look into that one by one. In case of minority interest, we have already seen what is that we are supposed to do. We are supposed to consider share capital first. So how many shares do they own? So out of 10,000, if 7,500 are owned by the majority shareholders, obviously 2,500 will be owned by minority shareholders. That multiplied by the face value, 2,500 into 10, that will be 25,000. And to that we should add what? Pre-acquisition or capital profits and post-acquisition or revenue profits. We just now did that working. In case of minority interest, the capital profits was 7,625. That's why we have added 7,625. And post-acquisition profits or revenue profits was 7,500. So we have added 7,500 here. So both put together it will be 40,125. So that will be the total minority interest. Likewise, if you look at the cost of control, which is nothing but how much benefit or detriment we have gone through by investing in this. For example, first we start with cost of investment. From where are we getting this 1,40,000 value? We have to go back to the balance sheet, wherein we have said that 1,40,000 is what we have invested to get 7,500 shares. So what is the return which we are getting by investing 1,40,000 is what we are concerned with. So cost of investment is what we start with, or amount invested, 1,40,000. First of all, we'll remove the share capital face value, number of shares into nominal value, 75,000, minus pre-acquisition profits. In this case, there is only 22,875, not much. So there will be a shortfall of 42,125. That means we invested 1,40,000 and we got back how much? Only benefits of 75,000 plus 22,875. So only 97,875 was our benefit. So remaining 42,125 is the shortfall, and this is called goodwill. If we had more benefits than the, or rather if the returns was more than investment, then we would have called it capital reserve. So here there is no capital reserve. So now finally we are proceeding towards the last working note, which is adjusted P&L, wherein we remove all the unrealized profit. So we'll have to go back to the additional information wherein they have mentioned what is this transaction is all about. Adjustment number 3, In January, H Limited sold to S Limited goods costing 7,500 for 10,000. That means there's a profit of 2,500, and out of this 50% is still lying unsold in subsidiary company's books. So now let us account for that. So we know 7,500 worth goods were sold for 10,000 rupees. So now what is the profit percentage here? Profit is 2,500 divided by the selling price of 10,000 into 100, which is nothing but 25%. So now how much is unsold? Out of 10,000, 50% this is unsold. So 50% of 10,000 comes to 5,000. Multiply that by the profit percentage, which we just now arrived at 25%. So that would be 1,250. So that is nothing but to stock reserve or unrealized profit. What we do is we incorporate the balance of profits from holding company this time, because we have to remove the profit from the holding company. So balance brought down is from the balance sheet itself. So if you go back to the balance sheet and check the P&L account balance, it is 45,000. So that 45,000 would be the starting point for us. So 45,000. So from there we are removing 1,250 because we have not yet realized this profit. So this is not ours, or we have not yet earned this. So removed. Then share in the subsidiary profits. This would be the revenue profits. Whatever profits we earned after acquisition. So 22,500. If you go back here, revenue profits or post acquisition profits, that will also be shown here in the adjusted P&L. So then whatever is the balance, this will be shown in the balance sheet now, not 45,000 as written. I hope that is clear. Let's move to the last step of the process, which is the consolidated financial statement or balance sheet. Now here there are certain things which we have to remember. When it comes to shareholders funds, we are only worried about H Limited, because whatever share capital is with respect to subsidiary company, it's already incorporated various places, cost of control, minority interest, etc., etc. So we don't have to worry about subsidiary companies share capital. So let's go back here. Let's check what is the share capital. 4 lakhs, general reserve 75,000. That is what we will incorporate here. Share capital 4 lakhs, general reserve 75,000. Adjusted P&L we just now did 66,250. So that is also considered. And lastly, minority interest will also come into picture here, which is 40,125. So that again is coming from the working note which we prepared earlier, 40,125. The same thing we have to write there. Then comes the current liabilities which we have. Here we have to be careful. As I said, these are the adjustments which we had to deal with only at this stage. So we'll have to deal with this now. I've already shown you this, how to do this, but let's look into this once again. So now first we add whatever creditors we have in both holding and subsidiary, which is 35,000 and 25,000. And then remove the mutual owings. So what is the mutual owings here? Mutual owings is 6,000. That means one company owes another company. That is, it could be holding or subsidiary and holding. Whichever company is owing, which company doesn't matter. We are simply removing the mutual owings. It doesn't matter which company owes which. So basically, this 35,000 of what is it? Subsidiary company. Sorry, 25,000 of subsidiary companies include 6,000 to be paid to holding company. If it's separate balance sheet, then we don't have to worry about it. But since it's a consolidated balance sheet, we can't be having any liability for ourselves. So therefore, we are removing this 6,000. So total minus 6 will be 54,000. Same logic holds good when it comes to bills payable as well. Bills payable includes liability of 12,500 of S Limited towards H Limited. So therefore, we are removing that too, and considering the net figure in the outer column, and then just we total this. That's all. There is nothing much after that. Same thing we'll have to do in case of balance sheet, asset side of the balance sheet as well. But before that, we have to incorporate goodwill here. So what is this goodwill? This is nothing but the extra amount which we paid for acquiring the shares of subsidiary company. If it was profit, would have shown here in the shareholders funds, and the item would have been capital reserve. So since we do not have that profit, we have to show goodwill on the asset side. Then comes the various assets, land and building. We just add holding company's land and building and subsidiary company's land and building and show it to the show it in the outer column. Same thing with plant and machinery. Add both and show it in the outer column. Then Preliminary expenses of holding company has not been written off, so that will be written as it is. Only the subsidiary company's preliminary expense was written off. Then comes stock. Here we have to be careful, because if you go back to this adjusted working note, P&L, we have shown that there is some unrealized profit, which is nothing but stock reserve. So that much we have to remove from stock, because that's is nothing but the profit. It is the inflated value of the stock. We can't have inflated value when we are mixing, or rather consolidating the accounts. So therefore we add the closing stock of both the companies and then remove the unrealized profit or the stock reserve. We have seen how to calculate that. Once you do that, you will get some net figure of 1,36,750. Then we'll continue with various other assets, current assets more specifically. Debtors, we have both 80 and 40, and again we remove this 6,000. It's not unrealized profit, this is mutual owings or mutual debts. The same amount which we removed from the creditors. If you see here, 6,000 is removed from creditors. Again, this, if it is creditors to one company, for other company it will be debtors. So we are removing that. Same thing with bills receivable also. Out of 22,000 receivable by H Limited, 12,500 is to be paid by S Limited. So we'll remove that. So we'll get a net amount of 25,000. Lastly, there is one thing here which we have to consider: check in transit. Even if you don't consider, the balance sheet will still tally, but since the adjustment has been mentioned, we'll consider that and show it separately. So S Limited remitted a check of 1,500 to H Limited, but the H Limited has not yet received. So what I will do is, from the bank balances of both the companies, we will remove 1,500, because to that extent bank balance of S Limited has come down. But we will not add anywhere, but instead show it separately and record it as check in transit, because that is also an asset which we will eventually get it. And this 1,500 will get added to 10,000, that is H Limited's balance. So this is just a minor adjustment, nothing great is happening here anyway. So once you total, you will get 6 lakh something, or 6,62,875. So this was a simple straightforward consolidation problem. So I would suggest, please go through the chapter once again. If you have already gone through, if you haven't, please go through that once. And if at all if there is any concept which you haven't understood, please leave a comment below. We will surely address your doubts there. And also please visit our website, www.excelacademy.com. So if you register there and log in, so you will get lots of materials and videos which we haven't put up on our YouTube channel. So if you need any extra material and notes like this, you can definitely register there. This is the notes which we have prepared, Ekcel Academy's notes. So we can access all these things there on the website. So thank you. If you have any doubts, we will meet again in the comment section.